When EXL acquired pure-play F&A outsourcer OPI in May 2011, their statement was clear, making their position as a serious F&A BPO player unquestionable. Founded in 1999, EXL has become one of the leading outsourcers in the insurance, banking, financial services and utilities and healthcare industries. And of course, one of their key horizontals in these industries and others is finance and accounting outsourcing. The head of outsourcing, which represents 80% of the EXL revenue, is Vikas Bala, and I'm very pleased to have Vikas joining me today. Vikas joined EXL in 2001 when the EXL capabilities were just getting started. They had established their first operational centre, and over the past 12 years Vikas has taken on a number of leadership roles and has been in this current role for 3 years. So hello Vikas.
Hi Susie, great to be here.
So let's start with the first question. I've been talking to a number of people at EXL and they're very buoyant about the market, and they talk very excitedly about growth within the F&A market in particular, which is obviously very exciting and great news. There are some observers of this market who are a little less buoyant about the future of specifically F&A outsourcing, suggesting that deal sizes are potentially dropping in value a little bit, and the number of outsourcing F&A deals isn't as large as it used to be, isn't as great as it used to be. Please share a little bit of the evidence that you might have to suggest that 2013 is really looking like a growth year for not only EXL but F&A outsourcing generally.
Yeah, sure. So, not only F&A, but even for most of the other non-F&A or any other domain-centric work, we saw that over the last 2 years that the deal sizes had started becoming a little bit smaller, driven primarily by some level of uncertainty in the marketplace, especially in the US and Europe, and also by the decision-making process becoming a little bit more elongated. So the deals were becoming a little smaller in size and were also getting a little delayed. But what we have seen in the last few months is that there is a little bit of resurgence in confidence. There is some clear visibility on what the future looks like for the industries, especially in the US. And what that has led to is a bit of a rejuvenation in terms of outsourcing deals coming through, especially in the F&A area. What we have seen actually in the last few months is that the deal sizes in the pipeline actually have become larger. Interestingly, what has also started happening is that the organizations are looking at F&A work to be done by domain specialists. So for example, if there's an insurance company who's looking at outsourcing their F&A work, not only are they looking at F&A capability that the provider should have, but they're also looking at whether they have an understanding of insurance. And the reason is that apart from the core controllership functions like accounts payable or accounts receivables or fixed assets or journal ledgers. Rather than just managing that, there is a significant amount of work which is F&A in nature but typically lies within operations. So it could be reinsurance accounting for an insurance company, it could be premium application, or it could be agency collection. And all these are F&A roles, but they are much closer integrated with insurance domain. We feel that if you have that combination of domain knowledge for the vertical and F&A capability, there is a significant opportunity which is coming through in the market. And some of the strategic deals that we have closed in the last few months are exactly in that sweet spot where we're doing F&A work both in the controllership area as well as in operational finance for our domain specialization areas, for example, insurance. So it's moving a little bit more from generic to more specialization, but we believe that large deals are back on the table and the momentum is good.
So it sounds like this potentially plays to the EXL strengths, having real specialization in the areas that we've talked about, like insurance and healthcare. And it also sounds like there's a bit of a trend developing with the customer really focusing much more on their partner having industry expertise and specialization. Why do you think this trend has emerged now? Why do you think it didn't emerge 5 or so years ago? What's caused the change?
Well, I think two things. One, that most organizations 5 or 6 years ago were not vertically focused. You had people working on horizontal. So F&A was a horizontal that providers were focusing on, or it could be customer service, etc. So the market was more aligned towards horizontals. It is only in the last few years that providers have matured along verticals, where they are focusing on providing end-to-end services for specific industry verticals. So one, I think there is availability of providers today who have domain capability. The second is, I think organizations are realizing that both to enhance value as well as to increase the scope of F&A outsourcing, domain specialization helps. So as an example, in an insurance company, if an insurance company is looking to outsource F&A, they cannot expand the scope from the core controllership functions to cover areas which are more operational in nature. So like I said earlier, premium accounting or a reinsurance accounting or premium application, these are F&A areas, but they require domain specialization. So they can both increase the scope of what they can outsource, thereby increasing their cost savings, as well as look at obtaining more value because a vertically focused player can actually provide more end-to-end process improvements for them. So I think both the availability of providers who are more domain focused as well as the potential increase in scope and value of F&A outsourcing has led to this kind of a trend.
You talked, Vikas, about value, so let's just focus a little bit on that. Historically, in the past, most F&A outsourcing deals were really decided on cost saving and labour arbitrage. Those times do generally seem to be times of the past. So my question to you is, in what ways EXL delivering benefit away from just pure labour arbitrage, which really is now generally assumed that labour arbitrage is a given within an outsourcing agreement. What is EXL doing above and beyond delivering cost savings where there's real value? And in addition to that question, where is the evidence?
I guess the industry is maturing, and I'm very proud to say that organizations like EXL Service are actually playing a lead role in helping the industry evolve. The equation that used to be prevalent earlier was that if there was a cost base of $100 that the client had for the F&A operations, the moment you can actually move it to a lower cost location through outsourcing or offshoring, you would take off, let's say, $40 or $50 off it. And then, suppose year one, the cost moves from $100 to $50, and then there's an expectation that there would be incremental productivity improvements, which is basically doing widgets faster. And that would give you 3 to 4% year on year for the next few years. So the equation was very linear. It's a one-time drop, and then there's a very slow, gradual slope for cost reduction. And I call it stuck in linearity. It's a very, very linear equation. What has happened in the last 2 to 3 years is that we have started focusing not only on productivity improvements, but overall effectiveness of the process. For example, if we can actually redesign or re-engineer the process in F&A to basically improve working capital, that could have a significant impact on the total cost for the client, which is not only limited to the productivity level in F&A, but it's creating enterprise value. So there are various ways in which we can focus on creating more value for the client, which is not limiting to productivities. You could either work on things which could enhance revenues. You could work on things which could prevent revenue leakage by improving reconciliation, for example. You can work on managing your work cycles in a way such that working capital requirements come down and the cost of capital actually comes down. You can work through looking at cost management in a slightly different way. And this is not about managing the cost of the people that we have. It's basically managing the cost of their operation. So what we've started doing in the last couple of 2 to 3 years is started focusing on the output, because we might be working on an operation which is costing $50, but we will be impacting an opportunity which could be thousands of dollars. We have started tracking a new metric which we call return on outsourcing, which we use for all our domains, including F&A. And the way we define return on outsourcing is that once the labor arbitrage benefit has been delivered, any value that we can add to our client by focusing on these output metrics, and that is signed off by the client, becomes a return on outsourcing. So it is net of any labor cost arbitrage saving. As an example, in 2012, our return on outsourcing was 19%. And the way to read that is if, let's say, there's an operation that's costing our client $100 today, after it has been offshored or outsourced, we are able to generate effectiveness-driven improvements which add another $19 to their P&L. And these are $19 signed off by the client. But it does not come as productivity improvement. It comes as working capital reduction, revenue leakage reduction, revenue enhancement, or cost savings which are of a much higher material nature. So that whole change of equation has been terrific, and there's a huge amount of opportunity by working on operations differently to create that kind of a value.
So that sounds very compelling indeed, and you've clearly got statistical evidence to back that up. So that sounds very impressive. I'm curious to know what the appetite is for working capital optimization from your client base. Looking across your F&A clients, what kind of appetite would you say there is?
You know, the appetite is huge. Today, when you look at the working capital reductions, which is adjusted for the cost of capital, because the cost of capital is low, people don't, the equation doesn't look as attractive if the cost of capital was higher. But even then, considering that we are working on managing working capitals of organizations which are billions of dollars of revenue, if you can impact that by 5% or 10%, that can have a huge impact even when you adjust it for working for cost of capital. So there's a lot of appetite for organizations to reduce working capital. However, if you can actually impact things which directly impact the bottom line, which is not a balance sheet item, but more impacting the bottom line, which could be revenue leakage reduction or revenue enhancement or reduction of cost in some other meaningful way, yeah, there's a preference for things like those.